Hi everyone, welcome to our educational webinar for today, Essential Tips for Tax Planning. We value everyone's time, so thank you for being here with us. And if you're not able to join us live, don't worry, you'll get a recording after this. Just to get things started, let me introduce myself. My name is James, and I'll be your moderator for the day. I'm the Business Development and Sales Executive here at Brew Accounting. So now, let me introduce to you our today's presenter. Joanna Stewart, as Director of Brew Accounting, has a passion for supporting small business to achieve mind freedom, time freedom, and financial freedom. She has worked across the globe leading large and small finance functions to deliver strategic business goals. She founded Brew Accounting 10 years ago and has gathered an excellent team of professionals together to support you and your small business to grow and prosper. So without further ado, let's give it, I'll give the control to Joanna Stewart.
Thanks very much, James. That's great. So look, there's lots to cover, so I'm going to jump straight in. I know, your time is very important, and therefore I really want to give you all as much as possible out of this webinar. It's an opportunity to really ask lots of questions, so don't waste that opportunity. I do encourage you to turn your camera on if you feel comfortable with that, and so that we can see your faces and I can assess if things are making sense to you or not. So before I start, I thought I'd share a funny quote for the session. Dear ATO, I'm writing to you to cancel my subscription. Please remove my name from your mailing list. If it were only so easy, I think we would all be writing this letter. On the other hand, Benjamin Franklin said there are two certainties in life, death and taxes. While this may be true, with a tax plan, you ensure you never tip the tax man. Here at Brew Accounting, we are more than just your typical numbers people, as we are a team dedicated to helping people achieve more whilst having fun doing it. Thus, this free webinar to educate others, so feel free to connect and share with others what we are doing. People have different opinions about taxes. Some people say they're boring, others say they're confused, and others, like myself, love interpreting the complexity and constructing tax plans to save people significant amounts of tax. We are interested to hear your thoughts in the chat section. So do you think that it's difficult? Do you love it? Love tax? What's your position on tax? Tax is a necessary thing, says Jean. Thanks, Jean. Yeah, for sure.
Thanks,
I agree with that. So if you don't understand anything as I go, though, just please do jot your questions into the chat panel. So hopefully you've all a necessary evil said. Hopefully, thanks so much, David. Hopefully you've all updated your tax plan to reflect your current situation. But if not, my advice to you is it is never too late to get started. Tax plans should always be reviewed when a significant personal or business life event occurs. Additionally, depending on the complexity of your tax affairs, we recommend reviewing the tax plan every year. This is especially because the tax laws change so often that if you do not review, you might miss out on a new tax planning opportunity or become non-compliant without even knowing. For clients with very simple tax plan, a review at least every 3 years would be recommended. So over the next 60 minutes, we've got a lot to cover. This webinar is about providing you with the latest updates from the ATO and demystifying the most common tax planning opportunities available to you at the moment. We'll then outline some potential next steps for you to take to make sure you have the best tax plan in place for your current situation. Please make sure you take plenty of notes today. Some of what we talk about might sound like a foreign language to you, what I like to call a Cantonese, so send through your questions at any time during the webinar for us to answer near the end. So the ATO has flagged 4 priority areas this tax season where people are making mistakes that they will be focusing on. In general, there are 3 golden rules when claiming tax deductions. So the first one, you must have spent the money and not been reimbursed. The second one, if the expense is for a mix of work-related, so income producing and private use, you can claim the portion that relates to how you earn your income. And third, you need to have a record to prove it. So just quickly running through those 4 areas that the ATO is concerned about. And to give you a few tips to make sure you stay compliant, I'm just going to give you a brief summary here. So with record keeping, the 101 of working with the ATO is that you can't claim it if you can't prove it. If you're audited, the ATO will disallow deductions for unsubstantiated or unreasonable expenses, and you need to keep your records for 5 years. So that's with record keeping. I mean, in Australia, we have a system where it's the responsibility of the taxpayer to keep their records and to also ensure that what they declare is correct. I think some people think because the tax agent signs off on it that they no longer have any liability, but ultimately it really still sits with the taxpayer. That's why we will always make sure to get the maximum tax savings for our clients, but we want to make sure to stay within the boundaries so that they're never at risk of an ATO audit of having fines or penalties. So number 2 is the work-related expenses. Look, there's a few things worth mentioning here. These are the ones that I think, are sort of on the radar of the ATO this year. So the first one is claiming self-education expenses. There really has to be a nexus to your current income generation, not where it will relate to future income generation. So that's something that the ATO is definitely looking at. So like if you are an actress, let's say, and you're going for a audition, the ATO will say you can't claim the costs associated with the audition because you haven't started to generate income yet from that job. So there's a fine line, The next one that we'll talk about is the working from home claims. Many of y'all will know that there have always been 2 methods, the 52 cents in the per hour and then the actual cost method. The ATO with COVID implemented another method called the 80 cents per hour shortcut method. And this is going to be available to the end of this financial year, 30th of June, 2022. You will still need to have evidence of hours worked, like a timesheet or a diary. But this rate, just keep in mind that this rate covers all of your expenses and you cannot then claim individual items separately, such as office furniture or a computer. So while with the 52 cents per hour method, you can then claim your phone, your internet, and decline in value of equipment and so on separately. What I will say is that the ATO is especially scrutinizing the method of actual costs this year, because what they find is that people who lodge the actual cost method tend to lodge much higher claims in their tax returns. And what the taxpayers don't seem to realize is that occupancy expenses cannot generally be claimed for employees working from home, especially for those who have been working from home solely due to the lockdown. So just to say on that, for all our clients, we will advise which method is available to you and calculate which will provide the best outcome for you. Final one on this is about motor vehicles. So again, 2 methods. One is the logbook and one is the cents per kilometer. If you're using the logbook, you really need to have a logbook. The good news is that one logbook that you keep for 12 weeks is valid for 5 years. Once the pattern of usage hasn't changed by more than 10%. Okay, now into rental properties, income and deductions, another area the ATO is keeping under scrutiny. Most people do the right thing here, but one area they're looking at is especially if you have property which is outside of Australia, a rental property, and you're an Australian resident for tax purposes, you have to recognize the rental income that you received on your tax return, excluding any tax you've paid overseas, unless you're classified as a temporary resident for tax purposes. So with that one, there's a lot of data matching across the world now. And so they really are, if people do have rental properties abroad, I'm sort of recommending to clients if they, for whatever reason, not been declaring something, it's time to get things on the books. The other one is if you have co-owned properties for tax purposes, the rental income and expenses need to be recognized in line with the legal ownership of the property, except in very limited circumstances where it can be shown that the equitable interest in the property is different from the legal title. So a lot to absorb there. And now we're going to go into one which has been getting a lot of coverage in the media, all about crypto and capital gains, you know, and also on capital gains and shares a little bit, but mainly on crypto. So a question that has been coming across my desk a lot is, when do I pay tax on cryptocurrency? And I did a six-week course this year on cryptocurrency. It's fascinating. It's evolving. Yes, probably still quite a risky asset class, but the ATO certainly is now truly aware of what's going on in this world and is doing a lot of data matching. So it's good to know what is required in this situation. So if you've acquired cryptocurrency to make a private purchase and you don't hold on to it, the crypto might qualify as a personal use asset, and then it doesn't have to go anywhere on your tax return. The thing is that that's not very common. In most cases, people are acquiring crypto as an investment, even if they do something, sometimes use it to buy things. Generally, a CGT event occurs when disposing of cryptocurrency. So this can include selling cryptocurrency for a fiat currency, example, Australian dollars, exchanging one cryptocurrency for another cryptocurrency, gifting it, trading it, or using it to pay for goods or services. Each cryptocurrency is a separate CGT asset for CGT purposes. When you dispose of one cryptocurrency to acquire another, you're disposing of one CGT asset and acquiring another CGT asset. And this triggers a taxing event. So it can get pretty convoluted, because a lot of people who are doing this are moving things from, one fiat, one cryptocurrency to another and back to the fiat, like Australian dollar currency or whatever. And all of these are different CGT events. So the good news, though, is transferring cryptocurrency from one wallet to another is not a CGT disposal if you maintain ownership of the coin. So the record keeping is extremely important. You need receipts and details of the type of coin, the purchase price, the date and time of the transaction in Australian dollars, and records for any exchanges, digital wallets and keys, and what has been paid in commissions or brokerage fees, and records of tax agents, accountants, and legal costs. The ATO regularly runs data matching projects and has access to data from many crypto platforms and banks. So if you make a loss on cryptocurrency, the good news is you can generally claim it, but only as a capital loss unless you are trading, and then you can claim it as a deduction, like an expense. So at the moment, we are recommending Coinly as a good platform to assist crypto users to simplify their admin and tax reporting around cryptocurrency. So a lot there. There's just one last little part. I'll talk about gifting of assets and where tax may still occur, but so far, any questions? I'll keep going because there's a lot to still cover. So with regard to gifting of assets, where tax may still be incurred, if you donate or gift an asset, it doesn't mean that you will avoid paying capital gains tax. So if you receive nothing or less than the market value for something, an asset, the ATO uses something called market value substantiation rules, and these might come into play. The market value substantiation rule can treat you as having received the market value of the asset you donated or gifted for the purposes of your CGT calculation. So just with regard to cryptocurrency and donating cryptocurrency might also trigger capital gains tax. So if you donate cryptocurrency to a charity, you're likely to be assessed on the market value of the crypto at the point you donated it. You can only claim a tax deduction for the donation if the charity is a deductible gift recipient and the charity is set up to accept cryptocurrency. So a lot there. I'm hoping that everybody is loving this as much as I am, but we're going to move into a bit of fun stuff now, away from sort of the more regulatory, just looking at what opportunities might exist in the future as we move from our current tax brackets into a different tax bracket in financial year 2025. So in in 2019-2020 budget, there was an announcement that there would be a series of personal income tax reforms, and we've reached the stage 3 of these reforms, and it's legislated to start in financial year 2025, which is the 1st of July 2024 to 30th of June 2025. So we're not quite there, but it's an opportunity that I want to explain to you in case you have some income coming to you, significant income. There may be an opportunity to take advantage of those lower tax brackets come financial year 2025. So what's actually happening is that they're pretty much collapsing the 32.5 cents and the 37% tax rates into a single 30% tax rate for those earning between 45,000 and 200,000. And the good news is that even with the new Labour government, Mr. Abbott, the Prime Minister, has told Sky News that people are entitled to for certainty of the tax cuts that had been legislated, and so that they will not be changing them, and it'll go ahead, and there's a certainty around that. So this certainty gives us some tax planning opportunities to consider deferring recognizing income in an individual's name, like by, example, collecting bonuses or dividends until the personal tax rate is lowered in financial year 2025. This deferring is only possible if the income has not been actually earned in prior years. So there's more information of this in our June 22 newsletter. So if you want to hear more about that, feel free to jump onto our website and have a look at our June newsletter. Just before I move on to the next slide, I just wanted to say that, look, we had a federal budget, and they had one day of sitting, and then we had a new government elected. So what happened is that a number of proposed tax changes in the had come through, but they were never introduced into Parliament, and it's totally, there's no idea if they'll ever actually see the day of light. So really, at the end of the day, we're pretty much just going to ignore that budget. We do have a blog called Election Results Are in What's Next for Tax on our website and socials, where you'll see which did go through and which didn't. Not many did get through. One that some people have been asking about is this 120% deduction for small business expenditure supporting digital adoption and external training. It did not get through. And so just forget about it, but keep an eye on our socials, because we'll keep our eyes on what's coming out of the government and make sure to keep you updated when it does actually pass legislation. So great. Moving on. So now we're going to talk about depreciating assets and loss carryback. Everybody still enjoying this as much as me? Listen, if you do have any questions, please just shoot them through. We're happy to answer them throughout the session, and I don't want anybody getting lost in the details, so don't wait and feel confused. If you have the questions, somebody else is bound to be thinking the same thing. So what I'll say about depreciating assets, yep, great, we can totally expense it this year, but at Brew, our position is buying that asset a good idea? Do you have a need for it? And have you done an assessment to make sure that it's a good investment for you personally or for the business? If the answer is yes, the good news is that these temporary full expensing measures enable your business to fully expense the cost of new depreciable assets, improvements to existing eligible assets, and second-hand assets in the first year of use. This measure enables an asset's cost to be fully deductible upfront rather than being claimed over the asset's life, regardless of the cost of the asset. So this is pretty huge, because usually it's like $1,000, and then after that you have to depreciate it. You can buy something for $1 million and expense it right away, So the last day to utilize this expensing measure is the 30th of June 2023, so they've extended it for 1 more year, but it's unlikely it will continue to be extended. So if you do have some assets to buy, this could be, either buy it before the 30th of June 2022, or you have 1 more year to do that. So a question we get asked is, if I build an office, can I fully expense this? If I build a warehouse, can I fully expense this? And the answer is no to that one, because certain expenditure is excluded from this measure, such as improvements to land or buildings that are not treated as plant or as separate depreciating assets in their own right. So expenditure of these improvements are called capital works and would still normally be claimed at 2.5% to 4% per year. Another thing to consider is that if you're buying a car, there is a limit which is based on the car limit, the luxury car limit, which will continue to place a cap on the deduction that can be claimed for luxury cars. For financial year 2022, it's 60,733, and for financial year 23, it's 64,741. So while there is this unlimited ability to deduct assets, if you're buying a car, you can't deduct more than this year 60,733 and next year this 64,741. And the other few things to mention about this is that if you're a small business entity and you're pooling, that means your aggregated annual turnover is less than 10 million and you're using the simplified depreciation rules, you can deduct the full balance of your simplified depreciation general pool at the end of the income year while full expensing applies. So, they also had some provisions about not allowing small businesses to re-enter the simplified depreciation regime for 5 years if they voluntarily left it, and that's been suspended. The other thing to keep in mind is that some businesses, especially if you're operating as a sole trader, you may choose to opt out of using this temporary full expensing because it may put you in a position where you're not even taking advantage of your tax-free threshold, and you do have an option to do that. You don't have to expense all your assets. You can choose to opt out for one and write off another, So a couple of warnings just around this. So the asset has to be ready for use. So if you bought a car now, and with the current wait times on delivery of cars, it's unlikely the car will be delivered before the 30th of the 6th, 2022. And so it will not be ready for use on your financial year 22 tax return. But rather you'll need to wait until the 2023 tax return to make that claim. So especially as you're getting close to the end of next financial year, make sure you have the asset ready for use if you're planning to take advantage of this. The other thing to keep in mind is that if you've fully expensed an item and then you'll only get one bite at the cherry, and I wonder if that makes sense to you, but if you go and sell that asset, because you've already fully expensed it, if you have sold that asset for $10,000, you're then taxed on that sale value and this is called a balancing adjustment, because you have no cost in your books to reduce the value you sold the item for. So there's a benefit, in that, yes, you got that full expensing, but then you're later taxed on any income you generate from the sale of that asset. So that's temporary full expensing. The temporary full expensing was introduced around the same time as the accelerated depreciation rules. And this was an additional mechanism to assist companies with cash flow as COVID progressed. So in layman's terms, it allows companies to offset current year tax losses against prior year taxable gains and recoup the tax paid in those prior years in the current year. So more specifically, temporary loss carryback rules allow companies that have tax losses in the 2020, 2021, 2022 and 2023 income year, any of those years, to offset the losses against taxable profits made in 2019, 2020, 2021 or 2022 income years. This relief is provided in the form of a refundable tax offset that is claimed in the company tax return when it is lodged. To utilize the offset, the tax lodgements need to be up to date for the last 5 years, and the loss carryback tax offset for an income year is limited to the company's franking account balance at the end of the year in which the company seeks to claim the carryback offsets. So that is actually fantastic, because while obviously making a loss is never going to be a good thing, it's allowing companies to recoup some of that tax that they've paid in previous years to offset some of these losses that maybe some companies are experiencing because of whatever reason, because they've gone and invested in lots of big machinery and they have a lot of expenses that they've been able to fully expense. So any questions there? All right, I'll jump to section 100A. So gosh, like section 100A, division 7A, all of this is just stuff from the tax legislation. I'll try and make it simple for you, and some of this may not really apply to you, so I'll try and keep this pretty short. But if it does relate to you and you want to book some time with us afterwards, please feel free. We offer a complimentary client meeting, and I'm happy to go through anything in more detail. So this has been big over the news. I don't know if you've heard about it, but the reality is that the law has not changed, but the ATO was concerned about how some distributions were being made to adult children. So section 100A is an anti-avoidance rule, and it applies to an agreement, which is called a reimbursement agreement, where one person receives a benefit from the trust, but another person, say an adult child on a low income tax rate, is made presently entitled to income and is assessed on it. So look, in English, in simple English, I'd say the main gist of this alert is that the distribution, if a trust is making a distribution, it must be within ordinary family dealings, and the actual cash should follow the trust distribution. So any unpaid cash, any unpaid present entitlements that are created for tax avoidance are under scrutiny. So look, a simple example, I'll give you one that is fine in the eyes of the ATO and one that is not okay in the eyes of the ATO. So first situation, there's a trust, mother, father, daughter, the daughter's at university. The trust pays for her university fees, $10,000, and her accommodation fees, $20,000. The ATO have no problem with that. It's probably clearest if the trust actually pays these institutions rather than the parent paying it and being reimbursed. And this is not compulsory, but probably, this is probably what's best. So in this case, the trust has paid for these fees, and the money has gone to that daughter, and she's been taxed at a much lower marginal tax rate than if the money had gone to her parents. No problem, because they consider that just ordinary family dealings, and that's what can happen. A situation which would not be allowed is, let's say you have a beneficiary and he has a big capital loss, and then the trust has a big capital gain, and the gain is distributed to the beneficiary with the capital loss. The trust also pays any tax of the beneficiary, an additional amount to that beneficiary to agreeing to enter into this agreement. So in this situation, the money hasn't flowed through to this individual beneficiary. It's just they're doing it for tax planning purposes, well, tax avoidance purposes, and the ATO won't allow it, and they're really just cracking down on that sort of stuff. So it's nothing that will affect most of us, I would have thought. Nothing has changed for under 18s because it's still for trusts. You can only give them $416, otherwise they're taxed at 66%. So nothing's changed there. With regards to Division 7A, just to give you a high level understanding of what's going, nothing's changed, but just in, so that you know what it is. A Division 7A, it's simply where the company loans money to an associate. And in order for this not to be considered a deemed dividend to the shareholder, a complying loan agreement called a Division 7A loan agreement must be put in place. The loan terms allow either for 25 years if the loan is secured on real property and 7 years if it's not secured. The ATO defines a rate for interest and principal that needs to be repaid each year. So, however, rules are tightening for companies entitled to trust income, and there's new guidance from the ATO, and that starts from the 1st of July 2022. So for the loans for companies, no big deal, but loans where companies are entitled to trust income, it is tightening. And if that relates to you, I definitely encourage you to be in touch with us. A few things that you need to do if you have a trust before the 30th of June 2022 is to hold a formal meeting before midnight of the 30th of June each year to document the basis of distributions to beneficiaries. If you have a company, consider repaying all the shareholder loans that are owed to the company. Not if you have loaned money to the company, that's not a problem. It's if the company has loaned money to you. Also review your shareholder loan accounts and either repay or ensure a complying Division 7A loan agreement is in place, and make that Division 7A minimum loan repayment. You may need to declare a dividend for that. So that's the long and short of Section 100A and Division 7A. Director IDs. So this is not really too onerous. I think there's been quite a bit of educating of the general population. So I'll keep this short, but there was a new legislation that was put in place where directors need to have an ID, and that ID will follow them throughout their life, throughout any directorship that they take on. And the main reason that was put in place is it was designed to flush out fake directors who were maybe taking on a directorship and then folding up the company with big debts owed to the ATO, and they couldn't trace these people down. So there's increased privacy protections for legitimate directors using this director ID. It's a very simple 3-step process, and if you need any assistance, you can reach out to us. But we also have a blog post called Company Directors. You'll need a director identification number from now on with a bit more information on our website, so you can log on there and it'll give you all the steps you need to follow. So that's a bit of information. I guess now what we're going to get into is some of the stuff that I kind of enjoy, because it's now getting that sort of information, like that's the tax law side of things. What we're going to get into now is a bit more of the tax planning and saving on tax, and that really is what interests me more than sort of just stating the facts of what we've talked about so far. So the first thing I'll say is if you're operating as a sole trader, many may not, but company tax rates are at an all-time low, 25%, and there's a small business restructure rollover, which allows non-company ABNs, such as sole traders or partnerships, to change to a company with no tax impact. So you can access this concession if your aggregate turnover is less than 10 million. And also you have to have 80% or less of your assessable income was base rate entity passive income. So that's something you might want to think about, because if you're you're only paying 25% on your tax on your profits, compared to if you're a sole trader or a partnership, you're paying at your marginal tax rates, and those can be a lot higher, as we've seen previously. Quickly, I'll cover off on taxation of COVID payments, because there've been a lot of different payments which the government has given, and some of them are tax-free and some of them are taxable. These are the ones that the ATO has listed so far that are tax-free. The New South Wales ones, the ATO's website has a link where you can see from all the states what different grants are tax-free. They're continually updating their website, so if you're not sure, I'd jump on there and have a look. The only other one I'll mention is around the GST of COVID payments. So the key issue is whether the grant is consideration for a supply. So was the business expected to deliver something for the grant? And if not, GST doesn't apply. So most of these grants don't have GST, but again, you just need to consider, is there a supply or not? All right, so now we're getting into the fun stuff for sure. So look, we ultimately are going to try and at year end increase our tax deductions so that we can reduce the tax we have to pay. Here are some of the key things that you'd want to be looking at the moment, just before the 30th of June. So with bad debts and with trading stock, you'd need to actually write it off, not just make a provision. So definitely go through your list of debtors and decide, are we going to be collecting this or not? And if not, then write it off. If in some future period the debt is collected, it will then just become income in the period it is received. So it's not like it's lost to you forever. But it does mean if you write it off, you can get that deduction before the 30th of June. Prepaying interest, the double benefit of that this year especially is that, yeah, you'll get the deduction this year, but also paying down debt at a lower interest rate, because the Reserve Bank seems to indicate that interest rates will be increasing in the near term. Super contributions. So definitely should be paid today. If you're trying to claim the deduction in this year, because for the deduction to be claimable in this year, the super fund must have received the funds on behalf of the employee. And if using a clearinghouse, this can take some time. You may have even missed the date already, but I'd say it's worth trying to get it in today if you're really planning to claim the deduction this year. So talking about, do you need to do a stock take? There are a few exceptions when you actually don't need to do a stock take. So if your turnover is below 50 million, and you can use this thing called simplified trading stock rules. And under this, once your trading stock hasn't moved from, using a reasonable estimate more than $5,000, you actually don't need to do a stock take. On the other hand, you may choose to do a stock take because each year you're able to choose the method by which you value your stock. So, and there are three kind of obvious methods. One is the cost price, easy. The other is the market selling value, or the other one is the replacement value. And what this allows you to do by using a different basis, which you can choose for each class of stock or for each individual item within a particular class of stock, this provides an opportunity to minimize the trading stock adjustment at year end. So there's no need to use the same method every year. You can choose the most tax effective option each year. The most obvious example is where the stock can be valued below its purchase price because of market conditions or damage that has occurred to the stock. And this should give rise to a deduction, even though the loss has not yet been incurred. So a lot of ideas there of what you can put through as some of the tax deductions to ensure that you decrease your profit so as to pay less tax this year. So superannuation is a aspect of the tax system that I absolutely love. This is something that many of you may be taking advantage of already, but this salary sacrificing into super. So there's two ways of doing it, and this right now I'll go through salary sacrificing, and then afterwards I'll show you how you can do it through a different method. But the benefit of it is, you have your salary and your wages. What you do is you say to your employer, I want to make an extra donation to I want to salary sacrifice an amount into my super account. That money is then taken out of your gross wages and paid to the super fund. The super fund then taxes it at 15%. And then you're only taxed on the net in your wages, which is fantastic because it really reduces the tax that you will pay. And I'll show you an example in a minute. Just be aware that that the threshold of, you can make a contribution of up to 27,500 this year in concessional contributions. It used to be 25,000, now 27,500. If you earn over a certain amount, and I think this year it was 200 or was it 250, you will actually pay 30% on your tax, 30% tax on contributions into the super account. It's called a Division 293 extra tax that you pay. But if not, it's that straight 15%. Be aware that the super guarantee, as you would know, is increasing to 10. Well, it was 10% this year, and next year it's going to be 10.5%. Most of your softwares will update that automatically. So how much can you sacrifice in 2021 and in 2022 and in 2023? So here's an example. If you're on 60,000 and in 2022 the super guarantee charge was 10%, so 10% of 60,000 is 6,000. You can then salary sacrifice 21,500 additional into super if you want. In the year ahead, where the super guarantee charge, which is what your employer will be paying, is 10.5%. They'll be putting 6,300 in. You can salary sacrifice 21,200, and you can see the table there of depending on what age, what income bracket you're on. So that then can be reducing your gross taxable income. Let's say your taxable income is 100, in this case 60,000. You salary sacrifice 21,200 into your super fund. You'll only be taxed at your marginal tax rate on 60,000, take away 21,200. And obviously the higher your income goes, the better outcome, because you're taxed at a higher rate. Your marginal tax rate is higher here, and therefore you're saving more money on what you salary sacrifice. You're only able to claim it in the year the cash is deposited to your super fund. If you contribute it not through your salary sacrifice, but if you actually put it straight into your super fund yourself. So this is something that you can do. So one option is the salary sacrifice. The other one is if you make a personal super contribution separate to your employer's super guarantee contribution. So you may be able to claim this as a tax deduction, and you'll need to provide a notice of intent to claim form to your super fund and receive acknowledgement from the fund before doing your tax return. And just to show you what sort of tax you would save, I just have a few examples here, depending on what tax bracket you're on, and say you put $5,000 into super extra. If you're earning between 45,000 and 120,000, you'll save yourself $975 tax on $5,000 super. And then going up the chain, if you're earning more, if you're earning between 120 and 180,000, you save yourself 1,200. And then if you're earning over 180,000, you're saving yourself 1,600, and that's on $5,000 super. And that's net, because this is the tax you would be paying if you were earning the money in your own name. But then when you contribute the money to super, you pay 15%. So this is the net tax savings rate, and that net tax savings rate times 5,000 is where we get this tax saving. So it's not a little bit of money. And if you think about making, if you were to make a $10,000 contribution, let's say here, you'd save yourself $3,200 in tax if you were looking at this example here, or 3,000. You would save yourself $2,400 in tax, which is not a little bit of money. So that's great. Look, there's so many things going on in this superannuation space, and so I'll just mention a few more things. They've removed the monthly minimum threshold. So Victoria said, what if taxable income is below 45K? I'm just looking at that comment there. Is it worth it? if it's below 45K, it's really marginally worth it because your marginal tax rate is 19%. So really all you're saving is about 6% on the money that you pay. But the next slide that I'm going to show you will actually show you if you're under 45,000, a few strategies that you might prefer to use if you still want to put some money into super. So super is good for anybody, depending on where you're at. The government does make it beneficial for lower income earners to also make contributions. So this removal of the monthly minimum threshold of $450. So you used to have to earn $450 per month from an employer before they had to pay super for you. Personally, I think it's a great thing that they've decided to remove that because I think it really impacted on a lot of casual workers, a lot of mothers who maybe didn't work in any one set job. So now as soon as you start earning money, they have to pay you that 10.5% super next year, which is great. The First Home Super Saver Scheme, look, a little bit more complicated to implement than I would personally have liked to see it implemented, but it is actually worthwhile to look at. So if you or someone you know is looking to buy a home, you can deposit up to $50,000 into super, not your super guarantee employer contributions, but additional top-up amounts. And you get a certain tax benefit. And ultimately, look, if you put 50,000 in and you stayed on the same marginal tax rate, you could save about 7,500 in tax per, if you're yourself and your partner, that, you know, and you can do up to 50,000 each. That would be $15,000 tax saved. So, and that's sort of very rounded numbers, but it definitely is worth looking at. As I say, there are some measures that you need to make sure that you tick a certain number of boxes and you do certain things. But do consider it. It was 30,000. It's now increased to 50,000 that you can put in, but a maximum of 15,000 in any 1 year that you can put in, and then you take it out when it comes time to buy the house. There's also a downsizer contribution, which is a wonderful way for people to get some money into super, and they've recently reduced the age from 65 to 60. So if you've lived in a house and it's been, you know, a primary residence for at least a period of time, and you sell it, you don't even have to buy a house that is smaller, but you sell it, and you can put up to 300,000 into your super. Your partner can put up to 300,000 into super, and they've reduced the age at which you can access that down to 60. So that's another good one to think about if those sort of conditions apply to you. This is the one that I feel like is the most exciting, and it's something called a catch-up concessional contribution. So this one is for people whose total super balance at the 30th of June in the prior year was below $500,000. What the ATO has now said is that if you didn't make your total amount of contribution, so I'm going back here, if let's say for the last 3 years you've only put in 6,000, but you were allowed to put in 25,000 before, it's now gone up to 27.5, but let's say it was 25,000, and that's been for the last 3 years. So instead of putting in 75,000, you've put in 6, 12, 18. You can now add the difference between 18 and 75 into your super fund in any 1 year. And where this is especially beneficial is, let's say you're selling a house and you're going to have a big capital gain, or you're getting a big bonus, and you don't want to end up paying tax on your highest marginal tax rate. They're saying you can do this catch-up concessional contribution amount and thus reduce and then be able to claim it as a tax deduction. So let's say you ended up putting in the difference between the 18, which had been contributed, and the 75. So that's what, 57? Am I right? Yeah, 57. Is that right, guys? This is my math. 75 take away 18. Yeah, 57. You then can claim that as a deduction on your tax return. So that's I think a really beneficial tax deduction that people can think about. The good news is that the ATO have made it really easy. If you log into your ATO MyGov, they've actually listed how much of this catch-up concessional contribution you can make there, and they're keeping track of it for you. So log in and have a look and see. The only other super strategy that I'd mention is this transfer balance cap. So not sure if you're aware, but you're now allowed to have, used to be 1.6, now it's 1.7, I believe, in your superannuation. And if you have a partner and one person is contributing a lot, they might get to their 1.7 million quite quickly, while the other person may not have as much. So what the government allows you to do is transfer up to 80% of your contributions to your spouse or your partner, so that you can equalize the balance of the two accounts and end up at the end of your career when you retire, where you're both able to have that full 1.7 million tax-free. Okay, so a lot there about super. Any questions? Okay, so I'll now jump on to Victoria's question around, if you're a low income earner, what can you do? Sorry, I'll just go back there. So there are a few things, and look, I've even recommended this one to my son, who's just has a little part-time job. So he's taken $1,000 and put it into his super fund, and because he's earning under this 41,000 threshold, the government's going to give him $500 into the super fund for him. So that's called a government co-contribution. That $1,000 that he contributed, though, is an after-tax contribution. So he's not going to get any deduction for making that $1,000 contribution. But already he's not even paying any tax because he's well under the 18,200. But just by him making a $1,000 contribution, the government's now going to give him that $500. And that applies to anyone who's earning under 41,000. You can take advantage of that. You can even take advantage of it up to 56,000, but you'll get less of this $500 amount. Then there's also this contribution low income super tax offset. And all this does is that if you earn under 37,000, instead of you having to pay the 15% on any contributions you make into your super fund, the ATO will refund any tax that you've paid. So there's that 15% tax is rebated to you, so that actually you pay no tax on the contributions that you've made. It sort of happens the year after, though. After you've lodged your tax return, the government sees that you've earned under 37,000 and it says, okay, well, I'm going to reimburse you the tax that was paid on those contributions, and then you get a refund into your super fund from the government, and it's called a LISTO, a low income super tax offset, LISTO, amount that goes back to your super fund. So that's that one. And then the final one is if you again earn under 37,000 up to 40,000 and your spouse makes a contribution on your behalf of $3,000, they will get a $540 tax offset for contributing on behalf of the spouse who's the lower income earner. So there are a few ideas there, Victoria, of what might be beneficial for you if you're under the 45,000. One of these might be more beneficial for you. So that's the end of my tax information. What I'll now just go to is, so what are your next steps? My aim is to help you to take what you've learned today and to implement some positive change to your tax plan. Now it's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your tax plan. So doing nothing right now, I hope, is not an option for you. And remember, we're here for you and want to help. You all have not really asked me too many complicated questions. Does anybody want to ask me anything? Now is your opportunity.
Yeah, we sort of kind of covered some of the questions already during the webinar, but if anyone else has any questions, you can feel free to use your mic, turn on your mic or cameras just to say it, or put it in the chat panel. or even share it in our feedback. Since I know we've gone a bit overboard, there's a lot of cover about tax planning, but we value your time, so we'd like to get your feedback. I shared the link in the chat panel, and you'll get a complimentary guide to your financial report as well. So
fantastic. Great, thanks, James. I'll just quickly run through this. Look, our next webinar is on the 21st of July. We realize how difficult it is to attract and retain talent in the Australian labour market at the moment. So I've gotten these two amazing humans, Claire Long, who's very experienced and knowledgeable in all things around retaining, and Janelle Patterson in attracting talent. And they're both going to share some really innovative strategies about how to motivate your employees to do their best work. And Janelle also is going to share all about what possible government incentives there are, because there are quite a few available, and it's free money that different businesses can access. So it'll be fun, and there'll be plenty of time to ask questions of these women. So, you know, keep an eye on our socials and your inbox for your invite to this, not to miss webinar. If you're, just to say, if you're new to our mailing list and you're not receiving your invites, you know, by early July, check your junk mail, because sometimes the communication for some reason gets lost in there. Thanks so much, everyone. Look, this is my final thought. Planning is bringing the future into the present so that you can do something about it now. And there's nothing more true than that about tax planning, because really you can do so much before the 30th of June, but after the 30th of June, sometimes it's a bit too late. So, you know, get in there and think about the tax plan for this year, and let's start talking about it for next year. Thanks so much, everyone, for your time. James, I'll hand over to you for the last little bit.
Yep. So if you can, if you didn't see it in the chat panel, you can click this link on the slide. I think it's a clickable link for you to give us a short feedback about this webinar, and probably what other topics you'd like us to cover. So we value your feedback, so we hope you spend a little more time there, and you'll get, again, your free guide to your financial report. So again, thank you everyone for joining us, and we'll see you on to the next webinar.
Thanks, everyone. Have a great day.